What are we doing today, Justin?
Hey, Josh. So today we're going to talk about silver and gold and a little bit of uranium, I suppose, miners, specifically miners that are juniors and that are in the exploration phase. So, just a quick note for those of you who might not be aware of it. On one end of the spectrum, you have like the Barricks and the Newmonts, the Exxon Mobils of the mining world. And on the complete other end of the spectrum, you have companies that have yet to drill a hole in the ground, but they think they've got some good prospects. So those would be like explorers. And then you have some things in the middle, right, of companies that are a little further along, whatever. So one of the cool things about going to the New Orleans Investment Conference, first time I went was this past last week, or whatever, was they had some big names in the precious metal space, like Jeff Clark, Rick Rule, Compline, and many other people who were very knowledgeable, much more knowledgeable than I. And one of the cool things that they did is throughout the conference, there was various panels, discussions, whatever, where these pros kind of spilt the beans on their favorite stocks, because on the juniors and on the explorers, it's incredibly risky. Again, these people think that they've got something, but they might not even drill the land. Now, there's a few reasons they think that they're onto something, especially if they're a seasoned pro. But again, the point is that think about Babe Ruth. This was the example that I think Rick Rule mentioned, was that Babe Ruth, until it was broken, many years after he died, was the number one, or had the number one record for home runs. Okay, he was a great baseball player. He swung for the fence, right? And he oftentimes would hit. But that being said, even though he held the records for the most home runs, he also had the records for the most strikeouts. And that's maybe the way to think of these, junior miners and these, exploration companies, where expect most of them to strike out. So in other words, be very conservative with what you're putting in. Of course, never put in more than you can lose. But hopefully, the
Yes.
ones that do win will win big. For our I'm sorry, Josh.
And this is like angel investing. You do not find one exploration junior mining company and put all of your eggs in that basket, because I would say you're guaranteed to lose. If you do succeed, it is by luck. And unless you're actually going to the mine, you're looking and you're an expert, I would say you're just absolute lucky. What I would say you kind of have to do is what Just did. You find the experts, and you get a lot of these picks, and you take the shotgun approach, because if these stocks take off, they're going to 20x. You don't have to worry about having a big position size on, because if they take off, they are going to absolutely rocket, because a company that they have like under 100 to 200 million dollar market cap, if they've done absolutely nothing, they don't even know if they have gold. If they find gold, they're going straight up, and you're hoping they get acquired by a bigger company. Sometimes it happens, sometimes it doesn't. You can't just invest into one junior mining speculative company. You need to do a bunch if you really want to succeed in the space. That's all I really have to say.
Yeah, absolutely. And like for anyone who's into a crypto or whatever, right? Maybe kind of like a way to think about this. Again, this is probably a bit of a stretch, but I would say it's not an unfair stretch, is that this would be like the altest of the altcoins for that. But the cool thing that this is maybe a little different than crypto land is that you can kind of see the development teams or the dev teams behind these guys, right? Like if you have people that have led successful exploration companies before, successful explorers turning into juniors and then sold off to a major, that actually speaks really, really well. So that's how you get the edge. The catch is that you and I mean, I suppose we could, but we are not 20 or 30 year veterans of the industry. But what you can do, as you said, is you can track down the people who are 20 or 30 year veterans, and see what they do, listen to what they say, and then just kind of do the same thing. So what I basically did is I kind of made my cheat sheet, and I'll share it with the screen here in just a second. But like for my case, about $500 is kind of the max I would go for myself in terms of that, like per position. But the good news is that just like with a crypto altcoin, you would not dump your entire bag in there, and if it does take off, then so be it. But expect to get rug pulled. But let's say maybe you buy 10 or 20 of these, you might lose out on all but 18. So in other words, let's say 2 would be winners, but the ones that win will win big. And the other thing too, if you want to look at a more logical standpoint, I suppose you could say you're buying, no, say it like this. You buy 100 ounces of silver, the price of silver goes up an ounce, you made $100 in theory. Duh. If you buy a mining company or an explorer, the price of silver goes up, the price of the mining company might go up $5, $6, $7. So in other words, you get leverage on the underlying price. But anyways, that's kind of the thing.
And so he's going to share this with you, which I think this is incredible. information while he's doing that, I'm just going to tell you that I am not currently invested in any of these companies except for one that is not a junior miner company. It's a already established producing silver, First Majestic AG. What I would really like to say is you can get this same type of leverage with options. So if you find a great silver miner like First Majestic, then I have options going out, say 2 years, 800 days into the future on First Majestic, where I can get a 20 bagger with that. But this is a company that's actually producing free cash flow, is a really good run company, and holds much, much less risk than if you're going into these explorations. Then I also have options on SLV or GLD, PSLV, the Newmonts, the Kirkland, not the Barracks. Barracks isn't my favorite company, but you can get this same type of leverage that Justin is doing without doing that shotgun approach with taking advantage of options. And that's just something, there's risk and options just like with everything else. But if you manage your risk correctly, you know your potential loss and you know your reward. So I think that's another great strategy. So let's take a look at the spreadsheet, Justin, and explain it for us.
Yep, absolutely. So actually, you mentioned First Majestic, and actually, First Majestic is the first one on the sheet. So, for everyone who's not familiar with First Majestic, the CEO of First Majestic, Keith Neumeyer, has a very active YouTube presence. If you want to learn more about the field, he's a very outspoken, very honest. It's almost like, I would say he's like the Andy Schectman, if you will, of mining, or maybe what Andy Schectman is to a metals dealer, Keith Neumeyer is to a silver miner. But anyways, First Majestic. And even though it's First Majestic Silver, I should note that they did pick up a gold mine in Nevada. So I guess it's really First Majestic Silver and Gold, but I don't think they're going to change that. The point is that if you want an established miner with proven leadership and a company that that is actually producing silver right now, First Majestic's your way. And as you said, Josh, just a second ago, if you want to lever up, you can do the option trade in First Majestic. So First Majestic, first thing on the list. The other ones are actually, I don't really know that much about them, just beyond the fact that these were recommended by some of the big names in the field. And so I'll just, kind of scroll through them really carefully or really slowly. But the majority of these guys right here, these would be either explorers or junior miners. So a few of these might actually be producing, but the vast majority are going to be upstarts, people prospecting, or people who have taken over an old gold lease or an old silver lease or uranium lease. That's that. The other thing I should note is you also have the royalty companies, like this one right here, Origin Royalties. And a royalty company is a company that's not necessarily engaged in mining per se, rather they're a financing vehicle in a sense, where if, let's say, you're trying to start a mine, and you don't want to issue any more stock, what you might do is you might go to a royalty company, and the royalty company might say, okay, listen, Mining Co., we like what you're doing. We will give you the money you need to build a mine. And in return for that, we want a 2% or whatever royalty out of all the metal that you mine. So of every 100 ounces that come out of the ground, in this example, 2 ounces would be paid to the royalty company. So it's another way to maybe go after that if you kind of want to keep your exposure limited. The last thing, Josh, that I'll add is Jeff Clark made a really interesting point where he likes to get the mining companies that have announced a drill decision. So that's, they've done the geology, they've been permitted, and basically they have come out and said, we are building a mine. But they haven't yet actually taken the first ore or whatever out. They haven't actually poured, the first, metal thing. He says this is a real sweet spot because you're able to tiptoe around a lot of the juniors and a lot of the exploration side because they've announced the intent to build. But at the same time, the market really hasn't caught on in the sense that they haven't actually produced anything. So that's a kind of a sweet spot right there. And if you see over in this column right here, column F, you can see kind of the notes about this right here. So
yeah. Like honestly, this is one of the most fantastic charts ever. Well, not charts, but like you did a great work here, really showing these experts in the field what they're buying. And I love that I have this option. This just isn't how I personally like to speculate. When I speculate, I like cash flow. I like to see and know the numbers that I'm getting into. This is pure speculation. This is almost as speculative as I'm not going to say as cryptocurrency as a lot of these altcoins.
No. Josh, you should. Like, what altcoins are to crypto and new projects? The exploration or the explorers and the juniors are to the mining. Like, I would say you're 100, or that is a very appropriate analogy to draw, I think.
And what I like to buy are the Bitcoins and the Ethereums, but I like, and Bitcoin and Ethereum, they go up so much. Like they're still absolute volatile instruments. I'm currently holding no cryptos, but with the miners, I want to get leverage on the companies that I think are going to do well. So let's say you can get a bull call spread on silver, betting right now that will silver be above $50 a pound in like a year and a half or 2 years. And I would say, you know what? I would say there's an above let's say 10, my personal opinion, there's above a 10 to 20% chance that could happen. And the market is pricing it where you could, I think, make a 10 to 20x return on that speculation, saying, okay, well, if silver's above $50 a pound, then you'll make like a 10 to 20x return on your money. And I think, hey, there's a 10 to 20% chance, so I'll put a small position on, and if that happens, great. If not, so what? I lost what I put in, and I'm doing that on a lot of different positions. I just looking at this, I'm saying, fuck it, I want to buy more First Majestic. And while we were doing this, I just put on some option contracts going 800 days out on First Majestic that are just cheap. You could buy them for like $2. And I think, and something that's really interesting with the gold and silver market is usually the way that the markets are set up is volatility is usually increased on the downside, and it goes down on the upside. But the gold and silver market are actually the opposite. Volatility increases on the upside and decreases on the downside because they go up so fast when they're in massive bull markets.
Yeah.
Which means when you buy these stocks, if they're going up, the stock, like these silver and gold stocks, they're going to go up, and the implied volatility is going to go up. So the options on these, they just absolutely skyrocket. And that's I think going to be an incredible speculation over the next few years. Justin, have anything else to add?
Yeah, the other thing I'll add to this too is that right now the market is seems to be in euphoria. I am really not a market guy at the end of the day. That is not my specialty, but it seems, just markets only go up. And I think back to something that Sheckman says, which I personally believe to be true, even though I kind of have yet to experience it, in real life, at least for the first time paying attention. And that's when the other day, Josh, we were talking about greed and we were talking about fear being motivators. And I would say that the market side of this is that when people, if people start freaking out and start rebalancing into metals, for example, first off, there's not enough metal to go around. But secondly, when this goes on, it's fear, not necessarily greed, that would drive it. And I would say that the motivation factor is that if this greed threshold passes, a critical threshold where suddenly, people start freaking out, it's gonna come on strong, and it's gonna last, or it's gonna come on strong and it's gonna go hard. That's just, I think, going to be the nature of the beast. So anyways, of course, trade however you feel like you is appropriate, to yourself. But at the end of the day, might make sense.
Justin, you're just a fear monger.
I know. I'm the doomer. I am the doomer.
I agree that everything will blow up, and I just am not willing to bet that's going to happen yet.